would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. It's Monday, September 12th, 2016. Welcome to a brand spanking new week. Breathe in that fresh new week air. Hope y'all had a great weekend. There's nothing more exciting than shopping for clothes for your children, which took up a major chunk of this weekend for me. So, as always, the very best way to get in contact with me is to head over to the website at www.therebelbroker.com. From there, you can check out the link to contact the Rebel Broker, fill out the form, send along any ideas, suggestions, observations, or questions that you might have, and I will be happy to reply. Of course, you can also visit over at the Facebook page or at the Google Plus community page. I'm amazed at how many people are kind of checking in over on the Google Plus page. There's not a lot of interaction going on, but there sure are a lot of folks sort of joining the community there. If you would like to as well, please feel free to do so. Again, links to all of these things at therebelbroker.com. There's a little palette of icons over on the far right-hand side, and each one of them is to a different thing. So if you want to follow on Twitter, or you want to join in on Facebook, or you want to go over to the Google Plus page, or any of the other numerous things, the iTunes page, whatever, feel free to use that as your direct route to any of those. In terms of if you're someone who's a little bit more into kind of getting more details on different articles, I go through an awful lot of articles on a pretty regular basis. And the ones that I find most interesting or that seem most related to things that could influence us in terms of decisions we're making relating to real estate end up getting tweeted. So feel free to follow my Twitter feed, and that'll let you at least see them sort of funnel by as the day progresses. So feel free to join in there. As I usually try to do, I'm going to try to focus on one subject today, and we're going to talk about mortgage pre-approval. I'm actually about to close an escrow, and I have some very interesting, at least very interesting for me, observations. I'm just trying to separate out what's what. We talked a little bit about this last week, and I'm noticing some odd trends, and I'm trying to figure out how much of it is VA specific, how much of it is FHA, does it affect conventional lending, those types of things. But there's definitely ripples in the lending world where there seems to be a tightening in underwriting, and I'm trying to figure out what the deal is with this. If I have any lenders out there, I have any folks who do loans all day long, I'd love to get your feedback because there's a very good chance this is simply a regional thing, something I'm just seeing in Silicon Valley. And the interesting thing is I've seen this now with two different properties, one in the heart of Silicon Valley, one a little bit less, one more in a bedroom community for Silicon Valley. And of course, the situations where I'm representing the sellers, I'm a little bit less exposed to it. But in my communications with the buyer's agent, I get the feeling these same things are happening. And I know I gave you folks some advice last week on adding a certain amount of time to your contingencies relating to your contracts based on this information. I still think that's a smart thing to do. You're going to want to get as much ground truth for your area as you can, because in a lot of cases, the longer the escrow, maybe it's going to depend on your specific situation if you're trying to buy something. But if you have a much longer estimated escrow period than other offers, that may not work to your advantage. So you're going to want to try to be as accurate as you can, but not hamper the desirability of your offer. So you want to get calibrated. In other words, you're going to have somebody ask some questions. You want to find out what works out best for the seller. And and here's another thing. And this is what bugs me, because all of these questions are solved with one question. All your agent has to do is call the other agent. If they don't want to call, send them an email. You just need to find out what the motivations are. Now, in the case of the one I'm working on right now, these sellers are hot to sell this thing as fast as possible because they're not living in it. It's vacant. They're currently paying for their current residence, plus having to pay for this. So they've got all these holding costs. So they're just hot to close this thing as fast as possible. And there's some other weird things that went on in this particular escrow that I don't quite get. In terms of things that the other side decided to do, which seemed to work counter to their desire to close faster. We can talk about that once escrow closes. That's my paranoia showing. But it looks like we're going to actually close on time, which, for my money, is pretty awesome. I can't claim full credit for that, but I know I've been the one with the cattle prod kind of making sure things happen. And when something was taking suspiciously long, it was my follow-up that relit the fire on that and got it done within a day of me pointing out that it was taking longer than it should. So, and of course, I'll share all that with you so that you can try to push your agent in the same direction, ask the same kinds of questions. Don't be shy about asking questions, and don't be shy about asking your agent questions. You know, what's interesting is one of the clients I'm working with right now, she is constantly saying, thanks for putting up with all these stupid questions and us bothering you. You know what? That is one of the many ways in which an agent is earning their money. This is not a favor an agent is doing for you. They are being paid to do this. So whether you feel like you're asking dumb questions or not, there's no such thing as dumb questions. You're not expected to know all of this stuff. When you take your car in to get it repaired, you're not expected to know the intricacies of how your transmission works or how the air conditioning works or how the engine works. But you may come to a point where things are happening and you want someone to explain to you what is happening. Well, your mechanic should be able to do that. That's the role. That's one of the many things that your agent is doing for you in this process, is explaining things in a way that makes it clear about what's happening and why it's happening. And what's interesting is not only did I notice the weirdness in terms of delays, the weirdness in terms of these really minor things that underwriters were asking for that I haven't seen them ask for in a very long time. My buyer noticed it because she went through the purchase process about 4 years ago, and from her experience, and she claims maybe she's just remembering it with rose-colored glasses, but it was far less annoying than the process that they're having to go through now. And what's interesting is these are not, I mean, we all know this is a human thing, right? So, of course, all different folks have different capacities for different things. And these clients are not someone tells me what to do and I don't know what they really want, so I sit quietly and hope it'll go away without actually doing anything type of people. If they're asked to do something in order to make this stuff go, they want to do it immediately, they want to do it correctly, and they want to make sure that everything's taken care of. So, you know, these are folks I can count on to communicate with their lender and give them what they need. So for her to make this observation, for me, was something to sort of reinforce the feeling that I had about what's been going on. So we'll talk a little bit more about that later this week. I'd love to get some more insights, though, from listeners, because I know I've got a ton of lenders who listen to the show from all over the country. I can't remember the gentleman's name. I want to say Peter, but I know you actually, back when the show was live, you actually called, if I'm not mistaken, and had some things to say about lending. I'd love, and you're in Atlanta, if I remember correctly. I'd love to hear from you or anyone else who's willing to offer up some opinions. And again, the best way to get in contact with me is www.therebelbroker.com and just click on Contact the Rebel Broker. So yeah, give me some insights. Lenders out there, give me some insights. Are you seeing underwriting doing bizarre things at an increasing level over the last 3 to 6 months? So just sort of calibrate me. I'd love to get, and I'd love to hear from people outside of my area. I'd love, if you have experience from right here in Silicon Valley, great. But I'd love to hear from somebody, say, in California, but not in the exact same geographical area like Sacramento. I'd love to hear from somebody on the East Coast. I'd love to hear from somebody in Phoenix, Las Vegas. I want different areas. I want to get a feeling for what's happening across the country, because I get the feeling if I get the feeling that it's more of a national thing, well, that's a bigger deal, right? That feels like something that we need to kind of put in our back pocket and figure out why that's happening. So anyway. But what I wanted to discuss with you today is, according to the Los Angeles Times, what they say are the 6 ways you're sabotaging your mortgage pre-approval. So I thought I'd share that. And if, of course, as usual, if there's any other magical Rebel Broker mojo I can spread over the top, I will, in fact, do that. And what's interesting, they actually we've gone over lists from other publications before that sort of relate to these kinds of topics. And this is one of the first ones where they actually brought up some things that I thought were interesting and things you may not realize. There were two lending experts that they talked to. Casey Fleming, a mortgage advisor with C2 Financial Corp right here in San Jose, and Heather McRae, a senior loan officer with Chicago Financial Services. And according to them, these are the 6 common mistakes and also some tips on how to avoid them. And again, there will be a link to this article included in the show notes for today's show. So as usual, you can head on over to www.therebelbroker.com. And you can click on read more, and you'll see links to the articles that we've discussed in today's show. So number 1, closing credit accounts is the things to avoid. Quote, once you've paid off a credit card or revolving debt account, you might be tempted to close the account so you don't run it up again. But doing so actually hurts your credit. To get a mortgage pre-approval, you'll need at least 2 current lines of traditional credit with at least a 2-year payment history. The longer you've had them, the better, according to Fleming. And check with a mortgage broker to find out how much your score would be affected by closing paid-off credit accounts before you make any decisions. So let me sort of expand on this one. And there's a logic behind this. By closing the account, it's closed. You no longer have access to that credit. When you have access to a certain credit account and you're not using it, my understanding is it demonstrates to lenders a discipline on your part, that you have access to this credit, but you're not running it up. Other things that tend to demonstrate discipline are credit cards that you tend to pay off monthly. Now, I've heard some folks, and I think we've had other things to do lists in terms of touching up your credit, where they've talked about actually carrying a balance for some periods of time actually looks better. But what they're basically think about what you're looking for. If you're going to loan somebody money and you were kind of basing it on your knowledge of them, if you knew that they would go to the bar and buy booze and use their rent money for that, they're not very disciplined in their finances, right? They're basically using different systems in order to try to assess that same thing about people they're trying to loan money to. One other thing to make sure of, and it may get mentioned later in this list, is you don't want to do a lot of weird things as you're going through this process of becoming pre-qualified. You don't want to be buying cars or furniture or any of that kind of stuff. You want everything to be very mellow and not have a high impact on the financial ins and outs for you while you're actually in the process of getting pre-approved or approved for a loan. And we've talked about this before. If you're buying a house, and I've had this happen several times, and one of the times I even warned these buyers ahead of time, once you are a couple of days away from close of escrow and you're trying to figure out what you're going to do with that big old living room because you don't have enough furniture to fill the house, do not go to Ethan Allen and buy $8,000 worth of furniture that'll get delivered 2 days after close of escrow. That's bad. And I've had it stall a couple of different escrows where we had to do some somersaults and a few other magical things to get everything back on track. But in both cases, it delayed close of escrow by several days. So that's something you want to keep in mind. All right. Number 2 on their list is what we are going to talk about next. But before we do, we're going to take a quick break. So don't go anywhere. We'll be right back for number 2 on the list of the 6 ways you're sabotaging your mortgage pre-approval. So don't go away. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. When I last left you, We were talking about the 6 ways you're sabotaging your mortgage pre-approval. We had only gotten through number 1 on our list. We're heading for number 2 now. Remember, this is from the Los Angeles Times, and they spoke to a couple of big dogs in the lending world over at C2 Financial Corp right here in San Jose, and also Chicago Financial Services. Number 2, paying down only high-interest credit cards is a mistake you're making. Quote, although this is the right approach most of the time, it actually helps more to pay down balances that make up a higher percentage of your available credit, a situation known as higher credit utilization ratio. When the credit rate utilization ratio reaches more than 50%, it can damage your chances of getting a mortgage pre-approval. Although it's generally best to have credit utilization ratio below 30%, if you have utilization across several credit cards, paying those accounts down at least below 50% can dramatically help your chances of earning your lender's stamp of approval. So think the utilization is what we talked about actually with number 1 in terms of showing discipline, right? You're showing that you're not over leveraged on the credit that you have. And what they want you to do is have it down closer to around 30% utilization of your available credit. Rather than, and it makes sense for you to pay down the higher interest cards first, but you want to sort of show that across the board discipline. And then once you've gotten to that stage, then you can start focusing on the higher interest rate cards. I know it's sort of counterintuitive from a consumer standpoint. You're being very responsible by taking out the higher interest rate cards. But if I'm not mistaken, that's not their fault. I bet if they knew what interest rate you were paying on these cards, they might take that into account. But if I'm not mistaken, I've seen several credit reports. I don't think there's a notation on there that indicates what interest rate you're paying. So I don't think there's any way for them to know that you're paying down the card with a lower interest rate. So there's no way for them to really conclude that you're being responsible by doing that. So kind of play the game by the rules on this one. Or not by the rules, but by the weird tweaked rules, because they don't actually know the reality that you're living under, so that you can manipulate the situation to the point where you're getting the biggest bang for the buck in terms of getting pre-approved. Number 3, and this is one we've touched on, taking out major loans. Now, this one is something that just if you sat for a minute and thought logically should make some sense, but you don't want to take out any major loans. Many borrowers make this mistake. Don't be one of them. Avoid taking out large car or student loans until after your home purchase closes. Otherwise, your debt-to-income ratio will be higher, and your chances of getting a mortgage will be lower because you're adding new debt at your plate while your income stays the same. So just make sure you're, that should just make sense. But I get some folks don't make the connection right off the bat. But you're going to want to put off any of those kinds of things till after you get your escrow closed. And remember, pre-approval isn't your close of escrow. In other words, don't wait till your loan has been approved. I have had folks that since their loan was approved, we were in the last week. One of those examples I talked about before. We were literally in the last week before close of escrow. The loan was approved, but they had, after all the approvals, after it had gotten out of underwriting, after everyone had signed off on the loan, there was a last minute check of the credit of the person buying, and this new expense was found for furniture, and that derailed the whole process, and we had to go back and redo some things. Okay. Number 4, paying off old debts you don't need to repay. Now, this one kind of surprises me. I'd almost like to do some checking on this one, but if it's the case, it would definitely be an important note for you to understand in terms of how to prioritize the things that you're paying off. So let's go ahead and hear what they have to say about this. Quote, if you have debts that have been in collections for several years, you may not have to pay them off. It's possible, depending on your state's statute of limitations, that the debt is no longer collectible and won't affect your credit score. And this is according to Fleming, who was one of the financial experts that they were consulting for this story. Quote, generally, states impose a limit of 3 to 6 years for collection agencies to collect debts, but the law varies from state to state. So this is one of those things where you're going to want to find out what the laws are in your state, find out what the limit is on these types of collections. And if you have ones that are older than this amount, you don't want to deal with those first. You'll want to lay out your current debt scenario and make sure that you've got dates on them and take care of the ones that are, I guess we could call them current. for the lack of a better term. But any of these ones that are no longer current and are no longer on your credit score or not affecting your credit score, do I say ignore them and never pay them back? You know what? If you go into debt on something, I think the right thing to do, regardless of what the legal thing is to do, is to pay that money back. If you agreed to borrow a certain amount of money under certain types of circumstances and something horrible happened, I get that. And you need time to recover from that and move forward with your life. But I also believe that as an individual, you have a responsibility to live up to your debts, even when it doesn't. When it's not something that's negatively affecting your credit. So my suggestion would be get everything in order, get all your stuff squared away that's going to positively affect your credit score so that you can move forward, but figure out a way to, as you go, deal with these quote unquote old debts that are no longer collectible. I think you just would sleep a little better if those were taken care of. Number 5, changing from salary to commission. This is an interesting one too, because there's different elements to this, and being a guy who does what I do, I have bumped up against this a few times. Mortgage lenders typically require a 2-year history of commissions or self-employment income for a mortgage pre-approval. If your income is 25% or more based on commission earnings, that means you must have documented proof over 2 years for loan pre-approval. This is a big one. And it is a huge pain in the bottom for those of us who do the self-employment thing. Now, I've done both. I've had many different combinations of this in the past. I've had long periods of time where I was 100% self-employed and I had to present 2 years worth of information based on income. I've had situations where I had a blend where I had income from a salary and also income from commissions relating to real estate. And I'll tell you, it was a heck of a lot easier to get a loan when I had some kind of a salary that I could point to. Everything just seems to go a little bit slower when you're dealing with the self-employment thing. But as long as you're well documented, as long as you can present all of these things, more power to you. However, let me also suggest this. If you are someone who is in that transitionary phase, do not transition over to full self-employment until after your escrow closes. I don't mean wait for it to be 1 week away. I mean wait for it to be closed and you're moved in and the money's already in there, right? Everybody's gotten what they're supposed to get. You don't want any change in your work stuff. You don't want any of those things to get screwed with before escrow closes. Treat it like a house of cards, and even the slightest weird breeze in your life could blow it all over. So just don't let that happen before you close escrow. Number 6 on our list. It's very exciting, isn't it? We have one more left after this. Or no, excuse me, it was 6. It was a list of 6. This is it. This is the last one. Waiting to cash in investments. Generally, according to this article, you need to have at least 3 months worth of cash reserves available to show the lender that you can continue making monthly mortgage payments if you lose your income unexpectedly. Securities such as stocks, mutual funds, and other investments are counted as part of your asset reserves for mortgage underwriting purposes. They go on to say, typically, though, cash assets need to be in hand for 2 or 3 months, depending on the lender, to be counted. The value of securities fluctuates, and it costs money to sell and convert those investments into cash, which is why mortgage underwriters consider them to be worth only 65 to 75% of their actual value when evaluating your credit worthiness, according to Fleming. Now, I guess I could share a personal thing. I'm not sure it helps. When I got divorced and we split the retirement stuff, the savings for retirement, because of the way things worked, I ended up getting a cash transfer into my 401k accounts. And I took a look at the situation, and this isn't do this because Robert says. This is, at the time Robert decided it made sense to do this. I was looking at the performance of the investments in my 401k, and I decided, you know what? I'm going to leave this as cash in my 401k. I'm not going to invest this in anything. And lo and behold, the 401k thing has lost money over time. It hasn't lost a ton of money, but it's lost a little bit of money. So I've actually done better by leaving that as cash. What am I suggesting here? Well, for me that worked because that money was in cash and I could get it wire transferred in like 3 days from that account. For the pre-approval I got to do the search that I'm currently in, that money all counted. So at 100%, right? Not the 75% that they were talking about. So what does that equal for you? Well, within your 401k, you could leave the money in your 401k if you think it makes sense. If your 401k is making lots of money, you don't want to dump something into cash when you're doing well, right? But if not, you could convert part of your 401k into cash, leave it in the account, and then have it count as cash. Now, you're also going to want to look at a variety of different things because it may be a situation where that doesn't work for you. If you're in a situation where that money would get penalized by a certain amount, depending on your age, if you're over a certain age, I believe it's 59, you don't get punished for taking any money out of there. But if you are, the money gets taxed. So there's a tax basis for it. So you want to keep that in mind too. So if you leave it in the account, none of that stuff's going to go into effect. So just keep that in mind. So don't cash in your stuff. In other words, yet again, treat your escrow like it's a house of cards. Don't do anything weird with your money. Don't do anything weird with your investments. Don't do anything funky with any of your stuff. Because it may end up rocking the boat in terms of what you're going to have happen relating to your loan, not just for pre-approval, but for sustaining that approval through the escrow process so that it ends up with a check being written for you to purchase that house. All right, folks. Thanks so much for spending your valuable time with me today. I really do appreciate it. As always, thanks for listening. I'll talk to you all next time.